Hello, my name is Dr. Renée Friedman, and I'm Global Head of Research here at EXANTE. It's my great pleasure to be joined today by my colleague, Horacio Coutiño, who's a multi-asset strategist in my team here at EXANTE, who will be holding the discussion primarily with a wonderful, knowledgeable person, I should say, Karthik Sankaran, who's Senior Research Fellow in Geoeconomics at the Quincy Institute for Responsible Statecraft. In addition, Karthik also has over 20 years of experience as a portfolio manager and a global macro strategist focused on emerging markets and FX. So lots of knowledge coming forward. And today we will be exploring how shifting geopolitics and geoeconomics, sanctions and tariffs are shaping global currency and bond markets. I hope you enjoy the webinar. We will be taking questions, which we will look to answer at the end of the webinar. So please do put any questions that you may have in the chat, and we'll try to answer as many as we can. I will hand over to Horacio, who unfortunately, I have to say, his camera broke right before we started this video. So you will just see his image, but you will hear him fully. So please.
Well, thank you, Renée. And thank you, Karthik. Thank you for joining us. As Renée mentioned, we are here to talk about geopolitics and geoeconomics, tariffs, sanctions, and how they can affect investment strategies. And I honestly cannot think of a better person to talk to as a perfect guest for this than Karthik Sankaran. So thank you. Karthik, first off, could you please explain a bit about the differences and connections between geopolitics and geoeconomics, and why a clear understanding of them can help investors interpret the potential impact of changes in each of them on their portfolios?
Yes, Horacio, and thanks very much for having me on today. Really looking forward to this. So I mean, geopolitics, I think people may remember if they played the game Risk when they were kids, is about politics between countries, about the strategies that different countries that take in the international order to gain strength through military or diplomatic or economic means, and I think that's always been the case. You can go back, several hundred years and find the interaction of politics and economics and diplomacy is how countries have always acted with each other. Along the way, relatively recently, we came up with a neologism, I think, called geoeconomics, which looks specifically at the way countries use economic measures in the geopolitical arena. And that means things like using tariffs, using sanctions, using export controls, trying to strengthen your supply chains, to weaken another country's supply chains, to use your control of financial tools such as currencies to gain access to markets, to deny your adversaries access to markets. So geoeconomics essentially is the way that powers, typically great powers, use economic and financial instruments to achieve geopolitical goals. And I think it's always been a feature of great power politics. Napoleon said an army marches on its stomach. So if you want to think about, getting more food for your stomach or driving less food to the other guy's stomach, that's one way to think about it. But it's really come to the fore once again, I think, over the last 10-ish or so years, because of this recognition that the U.S. and China were great powers engaged in a rivalry that had a very, very significant economic dimension. And that was because, China was catching up to the United States. And so I think the first effort at this, in a sense, was the effort to construct an alliance based on economics that China was kept out of, was the Trans-Pacific Partnership in 2015.
Right.
The idea
Yeah.
of the Trans-Pacific Partnership in TPP, which then foundered on the rocks of American domestic politics. So, you can think about geoeconomics, but you also think, and geoeconomics is still with us. But what's also with us and has been with us since the idea of TPP and the sinking of TPP is the interaction of geopolitics, geoeconomics, and domestic politics. So I think that's just how I think about, how these different things interact with each other.
Right, and it's always useful to have an historic perspective, and not get lost on an environment of trade headlines. And yes, moving on swiftly, the big story this year, in terms of macro, has been how the U.S. dollar has behaved, how the U.S. performance has behaved this year, being the dollar being down over 10% year to date. What do you see as the critical questions for the U.S. dollar performance?
I mean, there was what we saw kind of at the very beginning of the year and kind of after the election last year was the assumption that the U.S. would impose tariffs because that had clearly been part of President Trump's agenda in the first term. He's believed in, in those in tariffs as a critical measure for close to 40 years. So I remember that as a New Yorker in the late 1980s. And the assumption was that the dollar would rally on tariffs. That would be bad for other countries in the world, and it would also reduce the external financing requirement of the United States. That the U.S. as U.S. trade deficits shrank, the U.S. would need less recourse to external financing. Those two things were seen as potentially boosting the dollar, and that's something I have long had questions about. I'd written stuff about this in July. I had something in Barron's at the turn of the year, where I questioned this idea that the tariffs were going to make the dollar stronger, because to me, what drives currencies, it's not necessarily solely or most importantly the size of trade deficits. It's really the capital account. What drives currencies is the attractiveness of your assets. And
Right.
I had questions about whether tariffs would actually be seen to improve the attractiveness of U.S. assets. And this comes as, you and I are both, old EM guys. And my question was, we've seen other countries try this. We see Argentina try this. We saw Malaysia try this, and their currencies sank. And that's because of the assumption that what tariffs are doing, and what I, as someone who grew up in India in the 1970s, am very conscious of, is that import substitution across the board leads to less efficient capital allocation. And that in turn reduces rates of return, across the economy. So my argument was, first of all, that, this kind of capital account feature might well overpower the trade account feature of the U.S. simply needing to borrow less from the rest of the world. That was one part of it. I think the other things that kind of came into play were central bank independence, which is the other thing that we had known, right from the first term, is that Trump is famously a low interest rate guy. He likes a he likes a weak dollar. He has said so on several occasions. And in and of itself, that might not move markets if you had faith in central bank independence, that the independence of the Fed would remain guaranteed. But in combination with the market's read on the tariffs, the market's coming to what, in my view, should always have been the case, a correct reading of tariffs. So you had the central bank picture, and you had the and the tariff / capital allocation picture. And then the third thing that kicked in, I think that's very important, is that you had a really big move in the euro in particular, right after J.D. Vance spoke at Munich, where essentially he told the Europeans that they needed to do more for their defense. Right after that, I think within a day or two, Friedrich Merz, the Chancellor of Germany, said they had to rethink everything. And you had a very significant shift in German fiscal policy as a result. They sank they basically sank the debt brake in the outgoing parliament. So you had a third feature was a shift in the fiscal monetary mix, in the fiscal mix outside the US, as the US retreated from providing certain public goods, or said it was going to retreat from providing global public goods, critically defense. And so you got this big potential expansion in Germany, which then kicked off, I think, the biggest move that we. I think that was that was a very big impetus. So if you think about, so it kind of operated on three different levels: central bank independence, efficiency of capital allocation, and a big change in the fiscal mix outside the US and other developed markets that were dependent on a defense umbrella, that were then rethinking, well, maybe we need to do a bit more of this ourselves. So all those three things stick together. And those are the things that I would kind of continue watching, with the Fed portion becoming increasingly important just because of what we're seeing in terms of personnel changes and so on.
Yeah, that's right. And I mean, I'm gonna make a shameless plug here, but for those in the audience who don't know, Karthik wrote a sublime article called "Monetizing Primacy," which delves right into what current U.S. policies effects and the potential disconnect between U.S. policy and U.S. goals can have on the dollar. Which we'll share. Yeah, we'll share on once you get the recording. We'll share the link for that piece. What can you tell us about the effects that this has on the bond market? Should we expect, let's say, a higher term premia, and sometimes and yeah, pivoting from simply domestic issues driving bond yields now to probably fiscal dominance concerns coming more and more to the forefront? Or do you also feel it's something else driving the bonds market?
I mean, I think there's definitely I mean, if you look, I mean, things have what I've been looking at is kind of the 530 spread, basically, as an example of, or as an indicator of how big the concern is. And that's certainly, it's come in a little bit as you've had softer inflation numbers coming in. So there's potentially less concern about the Federal Reserve overlooking inflationary pressures. That said, I do think there is there's a fair amount of concern there, and it's been manifest primarily in that. It's also important to note that this is happening in global context, right? I mean, what you've seen is long bond yields in that 30-year sector rising pretty much everywhere, which is something we know, that global bond markets are indeed interconnected, even if you have different central bank reactions. I mean, the ECB has been much more eager to cut than the Fed has. You can still have, notwithstanding what happens at the at the front end differentially, which may show up in currencies, it does feel as though there is a bigger concern over fiscal trajectories in developed markets. Pretty much everywhere. These may abate for a little bit, given what inflation numbers are doing, but I think it's still something worth something worth keeping an eye on. And one of the points here that I tried to make, in the article and was referring to earlier, is that there may be two or three separate things happening at the same time. One is that if you do get a pullback in the U.S. defense umbrella around the world, it does require other countries, particularly the large surplus countries, to do more to spend for themselves. So,
Right.
Asking Japan, asking Europe to spend 5% of GDP on defense, asking Japan to do the same, asking Taiwan to do 10, all of this has a potential impact on the stock of global savings that could find their way into U.S. markets. Essentially, what you're doing in a sense is reducing, shrinking global savings investment gaps, which may be a good thing from the point of view of global demand. It's not necessarily such a good thing from the point of view of the U.S. needing to finance large fiscal deficits at such advantageous rates as it had enjoyed before. So the other thing I think that's happening here, and this goes to another aspect of geoeconomics, which is kind of attempts at deglobalization, which are driven in part by concerns about excessively close economic linkages to adversaries, in this case China, in part driven by domestic politics, because of the impact of that on the U.S. economy, on U.S. workers, located in the tradable sector, in basically what's essentially been the tipping point of the last pretty much every U.S. election over the last 20 years, which is the upper Midwest and Western Pennsylvania. So I think as you look at these things, I would also suggest that we're also seeing a structural shift in the world. I think the world looked one way between kind of 1998 and 2020.
If I can interrupt, Karthik, just to kind of really that impact, because you're talking about that impact of a changing geopolitical relationships. And we, as you've noted, we have seen, particularly over this year, past few years, in fact, geopolitical tensions rising across the globe. And there are a number of hotspots. We've seen how power is used by countries. You've mentioned more of the increased investment in defense, or expected increased investment in defense. We've seen some shifting allegiances. Basically, the world order seems to be fracturing, with countries trying in many ways to create almost overlapping, through these agreements that they're now putting up with each other, spheres of influence. So given all of that, what do you see as the implications for investors, whether it be investors in currencies, strictly in currencies, or in bonds, given that we are also seeing at the same time that steepening of global bond yields? Although EMs have benefited from this, have they not?
Yeah. I mean, I think what you're seeing now is a world in which you have serial supply shocks. That's one way to think about this. If the world after the Asian financial crisis was one where your dominant shocks were to demand, because the Asians were saving, it was the German response to the Eurozone crisis. Basically, most shocks that we saw meant demand sank while supply remained constant or grew. There was an issue in the oil in the early, I think, in 2002 to 2008, but that's cured with shale. It seems to me in the world after 2020, we may be seeing a world with more serial demand shocks. You saw one, serial supply shocks, I mean. rather than serial demand shocks. So COVID was one. You had the issue with supply chains. You had the Russia-Ukraine war, which hit global gas supplies, and then you have these pressures of deglobalization in addition to everything else. So I think that's something very important to keep in mind for bond markets. If you have a world where, if you're going back to a world that looks more like the 1970s, where your shocks are to supply, not to demand, that changes the relative balance of inflation and disinflation over the cycle. I think one reason why EMs have done relatively well in this environment is because of what has happened to the dollar, because the dollar has weakened. And within that context, I think what's kind of, I remember there was this great IMF report, in 2011 that made the point that China increasingly drives the global real cycle because China is the world's largest it wasn't back then, but nowadays it's the world's largest exporter of manufacturers, the world's largest importer of commodities. But the US drives the world's financial cycle because the dollar is the most important currency in the world. The dollar is the most important vehicle for cross-border borrowing. Most cross-border investors kind of benchmark to the dollar. And the Fed is the world's most important central bank because in that environment, a lot of central banks, particularly in emerging markets, end up shadowing the Fed because they're worried about imported inflation, imported pass-through, and so on. So a world in which you kind of have this paradox where all of these negative things that might have happened in terms of the trade impact of U.S. tariffs for the point of view of EM are being balanced or kind of even overcompensated for by what's happening with the dollar, which then gives emerging markets space not to keep hiking in the middle of a negative demand shock, in the middle of a negative trade shock, just because the dollar is weakening. They have had much more autonomy in terms of what they do with their monetary policy. And I was at the IMF meetings in the spring when the governor of the South African Central Bank made exactly that point. So, yeah, things are bad, but it's a good thing the dollar is weakening. This gives us space.
So thinking about the dollar moving forward, is really this point of, we have seen this level of weakening, as Horacio mentioned, it was down over 10% this year. What about this point of other currencies coming in to replace the dollar in portfolios? Do you see that, continuing? Do you see it increasing? Do you see this not happening? And if so, which ones and why?
I mean, I think it depends on which kinds of portfolios. And what we're seeing now is, what a lot of the research is showing right now is that the weakening of the dollar that we saw in April, most pronounced, I think, in April, May, was less dollar asset sales than hedging of dollar assets. And you had a lot of people, particularly in East Asia, putting on hedges for in their fixed income portfolios, and that's important. And it's a useful reminder that if you're a Taiwanese insurance company, an unhedged treasury is not a safe asset because your liabilities are in Taiwan dollars. So that basic point of view, it's you need to match your assets and your liabilities, and unhedged long dollar assets was proving not to be safe. So I think a bunch of countries decided, or a bunch of asset managers, wasn't even so much countries, decided that they were going to decided that they were going to do that. I think, and this is more, I should caution that I don't do this for a living anymore. But it's been quite some time. It also feels to me that this has been an exceptionally long currency cycle by the standards of things that you look at, because I think the big shift, the big dollar move, is not so much 2008, 2009, because that was just a reflex in a reflex to market heart attack, and not even so much 2011 at the height of the Eurozone crisis. It's really 2014 when you get the combination of U.S. shale coming online and in a big way, and the ECB doing QE that kicks off what feels like a very, very extended long cycle. But even by those standards, even if you start in 2014 instead of 2011 or 2008, this feels like a long cycle of dollar strength. And if one does in fact get the kind of fiscal shifts outside the U.S. that we're talking about, if one does get a change not just in the U.S. monetary policy cycle, but potentially a shift in how people think about the way U.S. monetary policy is going to be conducted in the future. Will it be allowed to respond to inflationary pressures? Will it be enlisted in the service of keeping bond yields lower? One of the interesting things that Scott Bessent wrote in his recent op-ed in the Wall Street Journal, he went to a lot of criticisms of the Fed that I don't necessarily agree with, but he asked for closer cooperation between fiscal and monetary authorities. And he mentioned a fact that is widely ignored, which is the Fed actually has three mandates. It has an employment mandate, it has an inflation mandate, and it has a mandate for moderate long-term interest rates. And people always forget number three. So when he said that, I kind of raised an eyebrow, and we'll see. But I think it's a very important that monetary policy story, not just about what the Fed's going to do, but what the Fed is going to be asked to do, what the Fed is going to be allowed to do, is potentially plays a part in how people see currencies from here.
Okay, so in terms of the influence of that, where you see the dollar heading from here, is it just weakening? Is that, is there any way out of that potential further weakening happening? Should everyone be hedging everything through on dollar in the sense of looking into other currencies, whether it be the euro, whether it be, we've seen a lot of growth, obviously, in China. There's been a lot of discussion about the role of the renminbi. Is that actually plausible or not?
I mean, my Horacio, did you have? Oh, I thought.
No, sorry.
Okay, no. I would put it this way, because again, I'm not actually a currency strategist anymore, but my experience, I would say there are trends, and then there's a mean reversion, but it is to trend. So that's how I would think about this. That if, as is my personal view, and I do not speak for any institution, I don't do this for a living anymore. I have to keep saying this. I will keep saying this, but there are a number of things that might argue for a shift in trend in terms of fiscal, monetary, in terms of what other places in the world are doing. But you will have, in the context of trends, you will get persistent mean reversion to that trend versus overshoots in one direction or another against that trend. So that's how I would phrase it in terms of thinking about, we've had a big move in a relatively short span of time. Does it continue at the same pace? Do we get some retracement? Thinking about this has how I used to think about before. I used to joke that just like there's no such thing as an atheist in a foxhole, there's no such thing as someone with a position who doesn't believe in technical analysis. You probably want to look at your RSIs or whatever you care about, however you think about these things. But so that would be my, in terms of trend versus, fluctuations around trend is how I would how I would think about it. In terms of what else might come into play, I'm interested in what's happening with the renminbi, and this is more from a kind of a a strictly geoeconomic angle, in the sense that we have, so far it seems to me that what China is doing is it's kind of riding the dollar down, which is in the sense that you've seen some appreciation in the renminbi, but it has also been shattering the dollar to a significant degree. So, for instance, it is significantly weaker against the euro than it was, a few months ago, at a time when EU-China trade tensions are rising, and there is, I don't follow this as closely, but Brad Setzer has been very persuasive on the idea that China is increasing its kind of shadow reserve accumulation, even if it doesn't show up even if it doesn't show up in SAFE. You also have demands for China to do more in terms of boosting domestic consumption, and we are seeing moves. They're incremental, but they do seem to be a shift in direction. And the question I keep asking myself is, given what I do now, is how might China weigh the economic advantages of continuing to have a renminbi that shadows the dollar and consequently is quite weak, versus the broader diplomatic and other advantages of allowing the renminbi to strengthen? And to me, there's maybe a compelling case here that China starts to think a little more about the diplomatic part of this. For one thing, what we're seeing in terms of Chinese technological prowess and the complexity of its exports is that these do not seem to rely on a particularly weak currency. They don't need to rely on a weak currency. It's not like their EVs are
Right.
kind of marginally better than anyone else at this price point. And I think one could say that across a whole range of higher technology goods. I think that's true. Rand had this very interesting piece on, basically, of the 10 things that China prioritized in its Made in China 2025, in 2025, they're beating the world in 5 of them. And they're close to the top in 3. So it seems to me on kind of an export competitive scale, they could afford a stronger renminbi. I think the diplomatic gains from doing that would also presumably be large. For one thing, it might take some of the edge off not so much the US, but some of the edge off European peeves. It would also mean that China leaves some of the lower technology, textiles, shoes, things like that, where they leave those a bit faster, giving more space for other developing countries, which is a complaint that many developing countries have had, is that China is basically occupying a very large spectrum of the technology space in its export mix. So it's challenging Germany and the US in some respects, but they're also cutting into exports from countries that are significantly poorer. And it may not be a bad diplomatic idea to release that space for development elsewhere. So, I think, I don't know how they think about this, but they've kind of
on that, if I could, very quickly, moving this on in terms of China's role. If you said, if they allow the renminbi to appreciate with the dollar declining, renminbi may or may not be allowed to appreciate. That does come into this point about potentially saying, could we see a faster realignment of countries being open to exploring more non-dollar lending, given that the cost of lending is very high, relatively high for many emerging market nations? Could China step into that breach? Could it be somebody else? And what will that mean for those currencies? What would it mean for the renminbi? What would it mean for the dollar? What would it mean for the euro? Any other currency as we think about this? Because obviously for investors, this is critical. These are the things that affect the valuation of those currencies.
Absolutely. And I think, I think of the dollar's central perch is not even so much that it's the world's number one reserve currency, it's the world's number one currency of cross-border borrowing. That
Right.
is, that's, to me, that's the single most important role the dollar plays. And it's going to be hard to dislodge from that anytime soon, just because there's network advantages, incumbency, liquidity, and so on. On China, what's interesting is that the low interest rate part is starting to play a role, in the sense that Chinese banks are now lending more in renminbi, and not just to BRI countries, but also in Southeast Asia, which makes a lot of sense, because
Just to
China
interrupt,
is
sorry, quickly again, for our listeners who may not know, BRI is referring to the Belt and Road Initiative.
Right. Yeah.
yeah, and I mean it's an interesting shift, because China went on this orgy of overseas lending, of about more than $1 trillion. But the important point is, it was all in dollars. It was not in renminbi, which is kind of an indication of just how central the dollar is in the system. But now they're starting to branch out into doing more lending in renminbi, which I think would actually be a very good thing, because if you are a country whose primary export is, let's say, iron ore to China or copper to China, and China wants to pay you in renminbi for that, the logical way to match your assets and your liabilities, your stocks and your flows, is to get loans in renminbi as well. And I think that's a broader, a broader principle, which also kind of shows the dollar kind of dominates three loops, but you are seeing China making some inroads in terms of bank lending. What's also interesting was an FT story a couple of days ago that some Russian gas companies were looking to issue panda bonds, which are bonds issued in renminbi, that both Chinese and non-Chinese people who want renminbi exposure can buy. And that's interesting, because to me, that's the next step forward. Cross-border bank lending in in a currency other than the dollar is one thing. Cross-border tradable securities lending, debt issuance, is another. And that's a step that emerging markets kind of went through with the dollar, kind of the 1990s, right? If you think about the 1970s, the bank crisis, that global debt crisis was about bank lending. And then you have the securitization into Brady bonds and stuff like that. And what you ended up with was a transition that everyone talks about now, kind of the disintermediation of global cross-border lending, as we've moved from bank-based lending to securities-based lending, a whole different group of players, asset managers, all stepping in.
So why isn't the euro
me,
taking this position?
I think the euro is certainly closer than the euro is certainly closer than the renminbi is. I think the euro's issue has been more, and Europe has a cross-border banking system that's at least as large, if not larger, than the U.S. banking system. Which is why, you go to any emerging markets crisis, there's like always, the dead bodies always include a few Landesbank, tiny banks, small provincial banks in Italy, and so on, and they have dollar exposure there. I think the issue in the European case is they have the banking footprint, they have a currency that is as freely tradable as the dollar. What they don't have is a large single market for safe assets anywhere near as big as treasuries, right? Because even if you include, your safe and your quasi-safe assets, Germans and Dutch, it used to be France. France used to benefit from its, and I would argue still does, and will probably continue to do so, because France and Germany was seen as the dynamic duo that, or not so dynamic duo that ran the eurozone, and but France always had this kind of weaker leg in its political economy that did not preclude global central banks buying a lot of OATs when they wanted euro-denominated assets, just because there weren't as many bunds to go around to satisfy the demand. So France was seen as the Sundance Kid, Tonto, whatever, of the partnership. They had the nuclear weapons. They had a seat in the Security Council. So OATs were the proxy. And, that I'm guessing will continue even if, even with all the turmoil. One thing I should mention is, because Renee asked what might change that, what might lead to a significant reappreciation of the dollar. A major eurozone political crisis has to be one of your contenders for that, for that story. Should one happen, I think that.
Karthik, do you think that the old rules, or at least expectations we have had around monetary policy impact on currency valuation, have fundamentally changed with this changing world order, as President Trump appears to be discarding long-standing diplomatic norms and sidelining former allies, just as we mentioned Europe?
Yeah, I mean, I think there's definitely, we've already seen that to some extent, right? I mean, the euro rally through ECB cuts. You had a Fed that seemed more hesitant about cutting, and yet the dollar fell. So I think that kind of relatively straightforward application of, just basically a carry trade mentality, it doesn't always work anyway. And we may be expanding the remit in which it does not work into the ranks of developed markets as well, because of increasing concern about but exactly the things we're talking about: central bank independence, whether there are going to be interruptions to cross-border flows purely on the basis of returns. You could have all kinds of, for instance, just as an example, how long, and will there be any lasting impact from this raid on the South Korean auto plant, right? I mean, these are things that we don't know yet. Maybe maybe dissipates quickly. Maybe it changes the willingness to do inbound FDI. Maybe it leads to thaws in other relationships. There are just a lot more moving parts. So I think monetary policy in and of by itself has all been susceptible to the fact that everyone knows carry trades implode periodically. But now I think you're introducing all these geopolitical factors. It's just even more complexity in that.
True. And speaking of the global south, there is, well, this is something I really want to ask you about. You have characterized the Trump's administration policy on the dollar as confused. But what are the implications for the global south should the US continue to pursue this set of policies?
I think the most important, I think it depends on the country. I mean, there are, this goes back to, I would frame it as, what happens if you're a global south country, what happens from here on out depends on the relative weight of your real exposure to the dollar versus your financial exposure to the dollar. So if you're Mexico, you have very high real exposure to the dollar. And so far, what it seemed like is that, the relationship has been pretty tranquil. President Sheinbaum has done an extraordinary job in managing that relationship. That said, we're about to go into the USMCA review process, and it'll be interesting to see what comes out of it, because the USMCA review itself is going to be a battle between kind of two it's like almost like, the thing about two angels, an angel and a devil sitting on opposite shoulders.
Right.
There's kind of there's a voice that says we must nearshore, which is we have to shorten supply chains, make them more secure, in which case Mexico is a very big winner. And
Right.
there's an argument that say we need to reshore, which is to say bring everything back into the United States, particularly in the automotive industries. That's a very strong call from the UAW, for instance. And the USMCA negotiations, I think, renegotiations, review, whatever you want to call it, are going to turn to a significant degree on what the balance is of reshoring voices versus nearshoring voices. And the peso has done pretty well this year on the basis of the Sheinbaum-Trump relationship.
Right.
It remains to be seen to what extent trade reemerges and as the major irritant here during the negotiations. And if reshoring wins, it's good for Mexico. If reshoring wins, it's bad for Mexico. If nearshoring, which is to treat Mexico as part of a unified American supply chain, wins,
Right.
that's good for Mexico. The other extreme probably is Brazil, that has very little real exposure to the U.S. It
Right.
has very high financial exposure to the U.S. just because the Brazilian central bank is notoriously hawkish, looks at inflation pass through. What the central bank does has big implications for Brazilian debt dynamics, because a lot of Brazilian debt is in floaters. So this year you have kind of a 9% deficit that everyone's freaking out about. Almost all of it is interest payments. The primary balance, if I recall correctly, is either negative 0.5 or may even be flat. So typically, this is my experience in the past, that the best time for Brazil is when
Right.
real interest rates are high, but they're starting to fall. Because,
And
so
yeah,
if we're there, then the fact of high financial exposure to the US and low real exposure to the US means that as long as the dollar remains on the back foot and the Brazilian central bank cuts, this is potentially, not a bad place for Brazil to have been historically.
definitely. And could you also point out to other countries besides Mexico and Brazil in the global south?
Yeah, I mean, I think, you know, one in ASEAN in general, I think is very interesting, because, there's a broad story here. I think the broader story is that it's not just that one of real exposure versus financial exposure. It's also one of countries deciding they want to diversify their trade away from the US as much as possible, and that they are not turning away from trade in general. And I think that applies to pretty much everybody except the US. So the EU is not talking, we might get an Mercosur deal by the end of the year. We may get an
Right.
EU-India deal by the end of the year. ASEAN is looking very proactively for what it can do outside. And, there's this perception that Chinese inbound investment into ASEAN is basically just a crude, um, throughput operation, and all of that's ending up in the U.S. But Gerard DePippo at Rand has done some very interesting work where he says, at most it's 1/4 of Chinese exports to ASEAN are showing up again as ASEAN exports to the U.S. What's happening is a genuine diversification of trade, and I think that is both a desire and a reality in large parts of the global South. I think that will continue. The num,
If I could,
even,
sorry, just to kind of go on that point about what China's been doing with the ASEAN, one of the things we've talked a lot about, the changing of supply chains, which is essentially what you're discussing. But what about the role and the impact of the sanctions that we've been seeing globally, whether it be sanctions potentially threatened against China in terms of when it was buying Russian oil. We see that against India right now. The wider sanctions that we may be seeing in terms of behaviors by governments, and we talked about this geopolitical shift. So you could bring that a little bit into the response on that and how that you see that affecting these further trading relationships as well as the currencies and bond markets as well, how the bond markets are interpreting this or should be interpreting this.
One interesting thing about this administration is that it actually does not seem to like sanctions anywhere near as much as it likes tariffs. And one argument I've heard is that sanctions, once on, are hard to turn off. Tariffs,
Right.
particularly under IEPA, are like, like in Bewitched, like Samantha, snapping her fingers, tariffs on, up,
Yeah.
down. We'll see what we'll see what happens with the with the Supreme Court ruling, but sanctions are definitely a big story. And here, I think what's really interesting is not so much this administration, but one of the lasting impacts of sanctions and asset freezes, I would argue, has actually been the gold price. The belief, the fear that sanctions or asset freezes were a weapon so profound that they could essentially freeze your economy. And these have typically been applied to smaller pariah economies. And then Russia was the first time they were imposed on a systemic economy. And I think part of the response to that in markets has been, you may be seeing a second order impact of this on bonds, but I think the big story here has actually probably been gold, where I think, you pointed out just this morning, pre-talk, that the value of global central bank gold reserves now exceeds the value of global central bank dollar reserves, at least as measured. And I think that's where this is. I think that's where this is really showing up. There's been a lot of work on the broader humanitarian impact of sanctions and so on. I don't think we're seeing a significant expansion of sanctions usage in this administration, as far as I can tell, mostly because it just loves tariffs as a way to do the same thing.
Right. And as we're coming to an end, I really didn't want to end the conversation without asking, what are you most excited about, or what are you most bullish about in terms of geopolitics and everything that is going on? What are the positive outcomes that are probably not on everyone's mind?
I think actually what I'm bullish about is actually rebalancing.
Yeah.
And this, to some degree, this is intended. To some degree, this is an unintended consequence of what the administration wants. But I do think we're going to end up, for a variety of reasons, with a world that is, over time, it's not going to happen immediately, in a world that is so reliant on American final demand as a motor of growth. And that's going to be because, the administration's argument that I kind of in the piece, the administration's argument seems to be, we want to continue providing two critical global public goods. Demand to some degree, though we want significantly smaller trade deficits. I'm not sure how it's going to work, but also we want the dollar to remain the central currency in the system, and we want to continue providing the global defense umbrella, but we actually we just want to be paid much better for those things. So that's the Mar-a-Lago Accord, all this talk, which is not really, I don't think it's going anywhere. But but as that has happened, other countries seem to have recognized that they need to do more to provide these goods for themselves. And a defense initiative in European defense is one of these. Mm-hmm. China seeming to recognize that it needs to do more to boost domestic consumption is another one of these. If that domestic consumption requires more central government fiscal expansion, that would be good. A combination of a larger global supply of Chinese government bonds, which are pure rate product. And I think one of China's issues is China has the world's largest debt market, but there are relatively few Chinese government bonds in that debt market because the central government doesn't like the issue. They're pretty tight-fisted. Means that a lot of Chinese debt consists of securities that are incredibly opaque in terms of accounting, in terms of seniority. So just expanding the global supply of Chinese government bonds and China accepting a gradual appreciation of the renminbi might be good to make the renminbi a somewhat more serious global contender for, still in third place behind the dollar and the euro. But if you look at all these things, and if what you end up with is a world that is more rebalanced in terms of where demand comes from, in terms of who provides defense, in terms of who provides safe assets to the world, if you have countries kind of remaking their internal patterns of trade and internal patterns of investment, could be China-ASEAN investment, could be Japan and South Korea investing more in other countries because they don't want not only Chinese investment there, and frankly, Japan and South Korea have been doing this all the time. You end up with a world that is much more balanced in terms of economics, in terms of geopolitics, in terms of demand, in terms of currencies. All of this, I think, some of these are intended consequences, some of these are unintended consequences, but I would tend to see these overall as broadly very positive for the world. So that's what I'm optimistic about.
No, that's great. That's great. Thank you. Yes. I think we would like to ask the audience if they would like to ask a question. They can type in on the webinar chat that we have available, and then we'll ask it to Karthik. Do you have something to add, Renée? Or
yes, I do. I think at the end of the day, when we're looking at this as investors, you've essentially said the dollar is still going to remain king, given the fact that we have the liquidity of those capital markets. You have as a trading currency, in the way that China doesn't, in the way that the euro is getting better, but it's not quite there yet. So I guess my question really is, how will this continue to impact when we look at, foreign investors, they're in dollars, they're looking to go into other currencies, so looking at what's happening in bond markets, and that's steepening. Is there anything that you see happening that should encourage investors about, particularly, let's say, bond markets, in terms of, will this steepening continue? Obviously you can't say exactly where you think they should be, but that the situation will either improve or why it may not improve?
On bonds, I'll say that, about a year and a half ago, I wrote something about bonds and why there would be, and why there would be buyers. I did it for Sherwood, and my rough idea was, and this applies more to 10s than to 30s, is that bond deals in that sector, 30s are a different story. There's, just because there are potentially other issues at work here, and there's also, it's hard to project out to 30. That's basically what it comes down to. But the idea was that bond yields should essentially settle, close to where, your expectations of trend nominal growth are in the 10-year sector. It was my rule of thumb. And in the context of a Fed that has an inflation target of 2% and its SEP forecast on long-term trend growth in the U.S. is 1.8, 4 seemed about right. Now, as you start getting questions about, if you do start getting questions about where, what the Fed's inflation target is, there was a stray phrase in a Truth Social post about everyone, 2 is too low or something like that. I was like, oh my God, this, so anyway, we're now in a few years where inflation has been above the 2%.
Been above target, it's been sticky across.
Yeah.
So that kind of leads to a question that we have from the audience about is, given all of that, what we see in terms of that high level of inflation in the US, and we've seen these rising bond yields globally, what does that mean for the US in terms of growth, in your opinion? Is stagflation possible?
Yeah, I mean, I definitely. I mean, the interesting thing about the Fed minutes, the last Fed minutes, and also you can also see this in the Beige Book, is not so much the arguments that people are mustering for why they want to cut. It's that the argument about cutters versus holders is entirely between people who think the risks from current policy to upside inflation are high, while the Dubs think the risks to current policy to push growth lower are high. No one has a good thing. No one sees a Goldilocks here. The basic disagreement is the current fiscal, trade, immigration policy mix putting upward pressure on inflation or downward pressure on growth. So when you have 19 people in a room gathered whose argument is about whether, oh, this is really bad for growth, or, oh, this is really bad, it'll push inflation higher, I think there's a reasonable case that the experts in the room, whom I do respect, think stagflation is a possibility. They're just arguing about whether it's the stag or deflation that's going to lead.
Okay. And on that positive note, I'd like to, it is, we've run over a bit. Thank you so much for an absolutely fascinating conversation. We've learned a lot about, the dollar, the impact of tariffs, the whole point in terms of supply, this being a supply issue now moving forward. The 2 critical influencing questions, the efficiency of capital allocation versus whether or not the banks or central banks are allowed to do what they should be doing in terms of controlling monetary policy in response to fiscal expansion. So lots of fascinating things, lots of things I think for people to think about and learn from as they look at where they want to be in their currencies, where they have to kind of consider the factors around their hedging or non-hedging, where they ought to be in bonds as well, perhaps, if they are worried about stagflation. And as you said, that is coming. So I'd like to remind the audience that this webinar has been recorded and the video will be sent out in email in a few days. So people should be receiving that because I know there's an awful lot to take in. A lot of really interesting things were said. And I just would like to take this opportunity to thank you again.
Thank you so much for having me. I really enjoyed this.